Okay, welcome everyone to Focus on Investing, Aligning Your Money with Your Values. Ding. Advanced slide, please. So my name is Leslie Crenna. We'll do a few more introductions momentarily, but I just want to open this event by welcoming everyone and letting you know that your accounts could be the largest part of your carbon footprint, depending on what is in your wallet. Couldn't resist myself. That phrase gets used quite a bit out there in the, I won't mention the bank. And today we are really going to think about that a little more deeply than we usually get than a single credit card. Please do stay on mute during the presentations, but there will be opportunities at the end to ask questions of our panelists and our moderator. This video will be shared on our YouTube channel, so you will be able to share it out with other folks and watch again if you wish. We are going to get started with our land acknowledgement. Brandon, would you go ahead and read that?
As we begin, we'd like to acknowledge the land on which we are gathered. For thousands of years, this land has been the home of the Patwin people. Today, there are 3 federally recognized Patwin tribes: the Cachel-Dihi Band of Wintun Indians of the Calusa Indian Community, Quetzal-Dihi Wintun Nation, and Yocha-Dihi Wintun Nation. The Patwin people have remained committed to the stewardship of this land over many centuries. It has been cherished and protected as elders have instructed the young through generations. We are honored and grateful to be here today on their traditional lands.
Great, thank you, Brandon. So again, I'm Leslie Crenna with Cool Davis. Brandon Rueda, also welcome from Cool Davis, our new campaign coordinator. We do not have any fellows or interns with us today. We got a last minute note from our intern that their midterm got extended. So unfortunately, Brittany will do a write-up after the fact, watching the video. I am going to pass off now to one of our Cool Davis board members, Rekha Vaitla, who is going to lead and moderate for us for the remainder of this event. But thank you also to the other board members that are here today. So Rekha, go ahead and take it away.
Okay, thanks. So I think, Brandon, we can move to the next slide. For today's event, welcome everyone again. And for today's event, I'll be the moderator. My name is Rekha. I'm a board member here at Cool Davis, and I'll give you some of my remarks to begin. Probably won't take 20 minutes. I'll try to keep it short so that we have time for even more time for the panelist presentation, because following that, Michael and Todd of USCIF and Green America will be giving us a wonderful presentation. And then we will go into questions. I'll moderate a few questions for them. And that'll be about 20 minutes. Brandon, can you go on to the next slide? And we encourage participant question and answer. So I think that if you look lower on your screen, you'll see a Q&A button. So if you have any questions while the presentation is happening, please put your questions there so that we can get to them. And after the presentations are done, you might still have questions. And so if you have questions then, feel free to raise your hand after the presentation. There's like a raise hand function. Or continue to put them in the Q&A, that's fine too. And I'll put together all those questions and present them to our panelists here so that they can answer your questions, and maybe I can provide a little bit of insight as well. Following the Q&A, if you can please complete the evaluation survey, it should pop up after you select leave. And it's just really helpful to us to know what's been helpful to you and how we can make our programming better. So with that, I'll actually go on to the next slide. So to level set here, we have culture and norms here at Cool Davis, and they're listed here to be solutions oriented. So let's share solutions and successes with each other because that's helpful, that's actionable. Let's be non-judgmental. Everyone comes from a different space, and so we should definitely be mindful of that. And everyone has different resources, different lifestyles, and we're all going through this journey at our own pace. And also make space for make the questions of others, but also take space, share your experiences, share your questions. Maybe you're thinking, what's an investment manager? Is that a financial advisor? Good question. And financial advisor is someone who can take a holistic look and help you with financial goals, whereas a manager maybe implements an investment strategy. And we all have questions. So some of us may even have greened our investments already. And so any questions, comments, experiences are more than welcome, because this is a safe place. So to converse, share, and learn. So I'm hoping that we can, get a really great discussion going today. Brandon, can you move to the next slide? Okay, so slight disclaimer from me. I'm not here on behalf of any current or past employer, and anything I say does not necessarily represent their views. I'm excited to moderate our discussion in my capacity as a board member of Cool Davis. And so I want to say thank you again for joining us for this presentation on greening your investments. And as we navigate this complex landscape of finance and sustainability, hopefully we're able to make it a little less complex today. It's imperative that we recognize the pivotal role that investments play in shaping our environmental future. Shortly, we'll delve into the significance of sustainable investing, explore current trends, and discuss actionable strategies to align a portfolio with environmental stewardship. The urgency of addressing climate change has never been more apparent. My family actually lives in Chicago, and I got a text saying, I wish you were here. It's nearly 70 degrees. And that's warmer than it was here in Davis today. So while pleasant, it's a reminder that our planet is changing in really unexpected ways and changing rapidly. So, investors stand at a crossroads where financial decisions can be a force for positive change. Some would argue that sustainability in investments can not only contribute to a healthier planet, but also demonstrates the potential for robust financial returns. Now, I say some because there are varying views on having your investments be impactful or driven by your values. Some people believe that impact investing sacrifices short-term returns for a mission or values-oriented purpose, and others feel that the sacrifice in short-term returns makes for a greater long-term value, and that there's an undeniable link between environmental responsibility and long-term value, and that's becoming increasingly evident. So there are also many strategies that folks focus on when it comes to greening your investments, such as divestment or engagement. Divestment can look a lot like a fossil-free portfolio and withholding capital from various sectors, whereas engagement can be a conversation with a company on how they can make changes, set goals, align with climate scenarios, and take advantage of having a seat at the table that comes with being an investor. These are all the views and opinions and questions that individuals have to navigate, and it can be really complicated. And so we're hoping to share some tools today that make it a little bit easier. Our discussion will touch upon the various aspects of greening in your investments. So we'll explore expanding universe of ESG, environmental, social governance criteria, how that can guide socially responsible investing, what these terms mean, and because identifying opportunities that align with your values or your preferences is paramount. And so we'll try to touch on maybe the evolving regulatory landscape. Governments worldwide are embracing sustainability measures. Understanding the implications of these regulations on investments can help contribute to informed decisions. And my hope is that you'll gain insights and practical strategies to kind of navigate all this dynamic field. So as an individual investor, the choices that you make today can shape a more sustainable and resilient future. That's something I truly believe. And so let's kind of recognize that power that lies in our portfolios to drive positive change. And I encourage you again to actively engage in the discussion, share your perspectives, and leave with a renewed commitment to greening your finances. So we're really happy to be bringing you the second part of Greening Your Finance series and convening wonderful individuals like Michael and Todd who work in this space day to day. And so I'll turn it over to them to introduce themselves before they go into their presentation.
Would you like to do the honors? Go first.
Sure. I'll introduce myself and I'll turn it over to Michael, who's leading off the presentation. So I'm Todd Larsen. I use he, him pronouns. I'm with Green America, which is a national nonprofit organization that works to create a green economy. And over the last 40 years, part of our work has been to educate individuals how they can use their money through their investments to create a greener world. And I'll turn it over to Michael.
I'm Michael Young. I'm with USIF, which stands for Sustainable Investment Forum. We have been around since 1984. When we were started, we were called the Social Investment Forum. There's a long history of responsible investing. The names and terminology have changed quite a bit over the years, but they can all still mean the same things. And we are also a nonprofit, but we're a trade organization based in Washington, D.C., and our members are financial professionals from across the country. So they can be credit unions that work on local impact projects, to financial advisors, to mutual fund and ETF companies, and everything you can think of related to financial services. So with that, let's jump right into the presentation. I do want to mention for those of you that since this is Davis, I'm class of '97. I haven't been in California since as a permanent resident, but I was pretty excited when I got the invite to speak to folks that live in my favorite town. So we'll start off with this presentation. So we've got a bunch of slides to cover. I'll go as quickly as I can. Brandon, would you go to the next slide, please? Let's start with kind of what we're going to cover today. So some folks call it socially responsible investing. Some people now say sustainable investing. We'll cover on what it really means. Rekha mentioned that we'll actually dive into the acronym ESG, which some of you may be familiar with. And if you're not, it may have come across your screen in political rhetoric last year. And then we'll work our way through investment possibilities, how you can engage your retirement plan, whatever structure that might be, whether it's a pension or 403B or 401k. And then lastly, how to potentially work with a financial advisor. Okay, thanks, Leslie. Next slide, please. Okay, so let's jump in. And by the way, as mentioned at the beginning, if you have any questions as we go, throw them into the Q&A box. And if they address the current slide that we're on, we'll do our best to quickly work in responses. And if not, we'll touch base towards the end. Just a disclaimer at the top, while Green America and USIF do work with many financial professionals, we are not investment advisors. So while we'll be talking potentially in some specifics as we answer questions, this is not financial advice, but more just for your education. Next slide, please. Okay, so what is this? So socially responsible or sustainable investing. What it is, it's investing that considers ESG, so environmental, social, and corporate governance criteria. The idea is that you use these extra data points to assist in generating long-term financial returns. And hopefully, if your analysis is good, you are creating some sort of positive social or environmental impact. You can do it across all asset classes. So that would mean any sort of investment type, whether you buy individual stocks and are engaging a company individually, if you're using mutual funds and ETFs, and you will hear all kinds of different ways to describe the space. So if you have been around long enough, like some of us have, myself and Todd certainly have seen many years of this, it was socially responsible investing till about the turn of the century. Then we started seeing people say just responsible investing more in Europe than in the States. There have long time been religious investors that used ESG data to help screen out some of the things that they would invest in or not invest in, and we'll touch on that in a little bit. Green investing is part of it, and so that aligns with what we're talking about today. Now, there are different nuances to what these different terms are, but they're often used interchangeably, so you can, if you'd like, use your favorite, and that works. Next slide, please. And the question that we often get when we're engaging new groups that may have some familiarity is, why should we do it? Why should we focus on sustainable investing? Why should we talk to our retirement plans? Or why should we think about using different funds or advisors that focus on it? And it's because it's one of the few ways that we can engage corporations, industries, companies, and their impact on society, both environmental, human rights. And as you can see from this list here, there's a lot of different ways that private investors, no matter what your structure is, no matter how small you are, you can have an impact. You can engage these corporations through your plans, through your funds, through your advisors, through networks like Green America, and you can make real change because sometimes fund companies will be directly engaging with a corporation that they might invest in to get them to disclose more information on their personal climate risk as a corporation, or what they're doing to make sure that they're addressing gender equity or racial equity, if there's anything they can do to make boards more representative than just, let's say, a family, which was definitely the case for a lot of companies over the past 4 or 5 decades. So let's jump to the next slide, because I want to dive a little deeper into is it popular? So in my time in the field, I started when we were in 2001, really was my beginning in this field, and not too many people were doing it. We definitely had religious investors. We had some folks that were focused on environment. We had people that were engaging corporations, even back to the 80s, who were concerned about apartheid and making sure that companies were choosing to divest their businesses from South Africa. But is it popular today? The short answer is yes. About $1 in $8 in the United States are now invested with some sort of sustainable investment approach. And if you go to the next slide, Leslie, I think this is really interesting, especially for tonight's audience. Morgan Stanley did a survey last year where they engaged all kinds of investors, not people who were necessarily interested in sustainable investing, but it was one of the survey questions. And what we found is in the United States, almost half of the people surveyed said they did have some interest. Now, that doesn't mean they've all implemented, but they wanted to learn more, or were trying to get their plans if they were looking at their retirement to offer them some options. And in that way, interestingly enough, the United States is a leader. Europe is very close, but something to feel good about. And for everybody here tonight, you're a part of this almost 50%, which is pretty exciting. Next slide, please, Leslie. So let's talk about ESG, because that's been in the news. It's an acronym. It has been turned into a political boogeyman for a little bit, but it's important to know what ESG criteria could be. This wheel on the screen right now is just a small example of what could be included. And why it matters is if you were an investor, let's say even 20 years ago, most of the companies that were in the S&P 500 or publicly traded, things that you would probably own in your retirement savings accounts, were producers of tangible assets, and they themselves, it was pretty easy to manage risk related to the corporation or the company just based on financial statements. You could get a sense of their cash flow. Were they a healthy company? How many employees did they have? What was their revenue? What we have seen over the past 20 years is this really big shift towards intangible effects, and sort of, for lack of a better word, the things that are not counted that affect the society we live in. So if companies are not, doing their best for water conservation and not reporting their water usage, it's really hard to make the case that individuals should be worried about things that they're doing in their home and backyard and communities because of the large impact of large corporations. Similarly, workplace safety, we have seen some really big disasters that have occurred that you might remember. In 2010, we had 2 that happened in the spring. One was the Massey coal mine accident, which killed a bunch of miners. And what happened later was, in reviewing workplace safety, the corporation was not keeping up with minimum standards. In fact, the CEO went to prison, didn't make up for the loss of life. And then in the same month, we had Deepwater Horizon, that disaster in the Gulf. BP had outsourced their drilling. They hadn't maintained workplace safety standards. And as a result, we saw not only loss of life, but really egregious ecological impact. And ES&G data points can help you as an investor or the professional investors that you hire identify some of these risks. So I'll use the example of Deepwater Horizon. Funds that were using ESG data, or professional investors, it could be your pension plan or the mutual funds that are in your retirement plan, those that were focused on utilizing ESG information would have had a relative ranking. So if you had to own fossil fuel companies, if you couldn't get rid of them completely, but your manager said, okay, amongst what we're considering, we're looking at workplace safety amongst these different extraction companies. And what we found is this one company is doing so much worse. And in fact, of course, this was all found out after the fact, too late to change anything, but the investors that were considering workplace safety had BP ranked very low. A majority didn't even have them in the portfolio. That didn't save the Gulf of Mexico, but it certainly helped those accounts avoid the 50% drop in the stock, which occurred once the accident happened. If you jump to the next slide, Leslie, I can show you, it's easier to read than the wheel, but if you think about ES&G on a company level, so if we talk about environment and we know terminology like energy efficiency and pollution, the question that you want to ask a company, whether you're thinking about buying the individual stock or if you're talking about a mutual fund that could consider different things, is are the managers of the fund, or when you're talking to the company, how are they managing their own environmental liability? I don't have to tell all of you in Northern California with somebody like PG&E, but if they're not keeping account of, what potential dangers inherent in their own business, how are they as a company going to perform as an investment for you or within an investment plan or portfolio? I mentioned already the social piece with workplace safety with BP, but it's not just how do they do for profits, profit margins, and what do they sell, but how are they treating all stakeholders? So that includes the environment and the environments that they work in, pollution that could come from it, on the environmental side, on the social end, long-term impacts on an economy. What happened to all the fishers and shrimp boats in the Gulf for years, right? They required a massive government bailout, and despite the penalty paid by BP, it wasn't close to the amount of money was required to fix the long-term impacts of that disaster. And then lastly, corporate governance. I'll mention this because, again, we're all in Northern California, but is there a check on power at a company? So, does the CEO, let's say at Meta, have a different share class of stock that affects your ability as a shareholder to engage them, to ask for things like board independence or board diversity? How are they giving money? And these things really can affect the long-term prospects of a company, because if leadership isn't checked, they can start to make decisions that are irresponsible. So I want to be cognizant of time. I think, Leslie, how am I doing? I think we've got another slide for my section before I hand to Todd, but I want to make sure I'm not running too long.
You're doing great.
Okay. All right, let's jump to the next one. So financial performance. So this is a question that I have gotten in my many years, no matter the audience, whether I'm talking to folks that are actually investment managers at pension funds that are considering hiring outside mutual funds or ETFs. I've gotten this from financial advisors who are often asked on behalf of their clients to find funds or consider funds, and have gotten this in conversations with not only retirement plans like 403Bs and 401Ks that use funds in a defined contribution structure, but even organizations like the Department of Labor, who make the rules about what kind of funds can go into a retirement plan. And so the short of it all is performance can be equal, better, worse. It really depends on the time horizon that you're looking at. But one thing is for sure is that no matter what performance you look at, whether it's a performance study in a shorter period of time, a meta study that maybe considers 1,000+ studies of performance, like the third one on this screen with the NYU Stern Center, I'll point to the chart because it really stands out. If you look at the white line, the MSCI USA, so MSCI is a data provider, an index provider. They're similar to Bloomberg or the S&P. So if you're familiar with the S&P 500, which a lot of people think as the broad market in the United States, the MSCI USA is very similar. It's a broad market, Most of the companies in the United States get included in that index. They aren't exactly the same because the providers are different, but they're very similar. And then you'll see this yellow line, the MSCI KLD 400. So in 1990, there was a company called Domini. They created the Domini Social Index. So they looked at the entire investment world of public companies in the United States. They identified 400 that they thought were doing a better job of managing social and environmental risk. And they said, this is going to be an index that we're going to track because these are companies that we think are doing business in a better way because they consider all their stakeholders. And they have leadership that is thinking long-term, not just about quarterly performance, but generational performance for a corporation. And as you'll see, this index, which was renamed through acquisition, MSCI bought it, and the name changed to the KLD 400, but it's the same 400. If you go back from 1990 through the last few years, what you'll see is not only is performance pretty equivalent, but in fact, there's long stretches where it's actually outperformed, not just in total return, but in risk-adjusted returns. What I will say is, of course, past performance, and you see in very tiny print on the screen, past performance isn't indicative of future results. But I think the really important takeaway here is that if corporations themselves are considering their own environmental impacts and social impacts and the risks inherent in them, especially in this increasingly intangible world where we have more software companies and more leadership that at times can be erratic, things that affect stock price but aren't necessarily a financial line item, you can get not only equivalent performance, but in fact, the companies that are focused on sustainability tend to do as well or better over longer periods of time. And no surprise then, if you buy a fund or your pension fund is considering these similar things, you similarly are going to get results that you're going to be pleased with. I will say, again, it's not that we're looking for necessarily outperformance, although it definitely happens. It is that incorporating these things that matter to us and a sustainable future and a better world don't hurt performance. And I think for the naysayers and the folks that have maybe for now 30 years tried to disprove the benefits to the individual companies, it is fair to say as an investor, and that means all of us, it certainly doesn't hurt us. And if we want to improve the world that we live in, the least we can do is ask our managers to think about these long-term critical risks. If you jump to the next slide, how do we use ESG? So Todd will get into more of like how you might analyze the funds, but just on a real simple level, whether you're an individual investor, a pension fund, or a mutual fund or an ETF, you have a couple of different ways you can use ESG data. One is you could say, hey, listen, if somebody has a really terrible environmental score, and by the way, ESG data is relative. So sometimes you can compare your ESG information to the whole market, and sometimes you just compare it to your own industry. So while not all of us maybe want to own fossil fuel companies, if you had to own one, you'd want to own the one that is investing in alternative energies, is considering local impacts, making sure they're controlling pollution and meeting standards, and that they're keeping employees safe because those employees might be your family members or loved ones. So how you might use this is you could say, I'm going to choose to exclude certain companies or certain types of industries. Your motivations can be very different. Some people are driven by religious values. Some people are most worried about the environment. Some people combine them. So there are options. You can get out of individual companies completely depending on your investment options. Another way to do it is to take all the ESG data and, as I said, do relative ranking and say, hey, we're going to try to buy the best companies that we can, but in industries that we think we should own because they're important. It could be manufacturing industries that we think are good for employment in the regions that we live in, or the areas that we work in. So for our own jobs, we might want to say, hey, I want to own the best of these types of companies that in some cases maybe have areas of concern, because those best companies hopefully are addressing them or thinking about them long term. And then, this last bit on the slide just sort of what sort of examples of how you might do this. Todd will get further into this, but you can do this across the board. You can do this in funds and retirement plans. You could do it if you have jumping into individual companies. You can buy certain types of bonds or notes, depending on where you do your banking. You might be able to get into a loan fund that is focusing on a local impact strategy to help potentially create affordable housing, or a CD that is structured around a bunch of loans that are focused on something that affects the community that you live in, hopefully in a positive way. So one more slide, I think, and then we'll be handing off to Todd here. But what I'd say is, and I did see a question come up here. Let me see if I can open up the correct box. It looks like it came into the chat box here. But the question about screening out seems relatively easier. That's definitely true. But what I would say is with ESG funds, and Todd will touch on this, you have to vet them, right? So due diligence, doing your homework, is just as important for sustainable or socially responsible funds as it is for anything else. You've got to dive into the details and make sure that you, or if you work with a financial professional, financial advisor, are doing that homework for you, because not all funds are created equally, and not all managers are as good as one another. So you want to do your homework. So with that, I will hand over to Todd, and I'll stick around if there are any questions towards the end.
Great, thank you, Michael. And that's a great introduction and great overview of the growth of socially responsible investing, and also busting the #1 myth about social investing is, does it perform well financially? And over again, thousands of studies have said yes. So I think the answer is definitely yes at this point. So thank you. So I'm going to talk a little bit about how we as individuals can actually get involved in socially responsible investing. And in terms of being an investor, being a social investor in some ways is similar to being an investor, period. Your first thing you want to do is set your financial goals. Are you trying to invest for your retirement, for a college fund? So think about that. Think about your risk tolerance. If the stock market goes down, how much of a decline can you tolerate personally? And think about that as you make your investments in your portfolio. And then determine how much money you can actually put aside every month as an investor. What can you put into a bank account? What can you put into your investments, whether that's through your 401k plan or through your own investments that you hold? These are all kinds of things you'll have to do, just like any investor. But with social investing, as Michael said, there's a second layer on top of that, and that's what kind of world do you actually want to see in the future? What kind of world are you investing for? So do you care about climate change? Do you care about human rights? Do you care about equity and diversity in corporations? Or do you care about all of those things? You have to think about that as well, and then figure out which kinds of investments you want to hold that match the values and the kind of world you want to have. So the first step is there's different ways of being a social investor. One way is to actually directly hold individual stocks in a company. And oftentimes people hold individual stocks, maybe because they've inherited them. They could have received them from a corporation that they work for, or they actually purchased them themselves. And in any case, what you're looking for here as a social investor is to see, do your holdings actually match with your values? And this has actually gotten a lot easier over the last few years, because when I used to talk about this topic about 10 or 12 years ago, I did a presentation at Motley Fool. It was very, very hard to find this kind of information on companies as an individual without paying money for it. But now, because corporations release corporate CSR reports, so corporate social responsibility reports, they do third-party reporting to places like Carbon Disclosure Project about their emissions, their water usage, their forest impacts, and things like that. That information is actually out there. And then also a number of nonprofit organizations are looking at the largest companies out there and ranking them against their peers on things like climate. So you can go to the Climate Action 100 or Corporate Knights Clean 200. As You Sow, which is an investor advocacy organization, rates companies on racial equity and workplace equity. You can look at rankings of companies on human rights, on LGBTQ rights. So there's a lot of information out there that you can look at and get a sense of how well a company is performing, how well a sector is performing, and whether you actually want to hold that stock. And the other piece that's gotten a little bit easier is if you want to be a direct stockholder, you can actually now buy fractional shares on a number of platforms, including Robinhood, but also even like Schwab. So if you want to, you only have like maybe $5,000 to invest through fractional shares, you can diversify a portfolio by only holding a portion of each of the companies you want in your portfolio. Next slide. And if you hold individual stocks, we strongly encourage you to be an active share owner with your stocks. As Michael was saying, one of the advantages of holding stock in a company is you have a voice with that company. And one of the best ways to have a voice with that company is to actually vote your proxies. So each proxy season, once a year, companies send out ballots to all their share owners. So even if you own one share in a company, they will send you the proxy ballot to start voting your shares. And those proxy ballots are pretty lengthy and complicated for a lot of people. So unfortunately, a lot of individual investors don't actually vote their proxies. They just put the paperwork aside and forget about it. But we strongly encourage people not to do that. And there's resources out there to help you understand your proxy ballot and actually vote it in line with your values. So for example, you'll receive proxy ballots, and a lot of times they will have ESG shareholder resolutions that have been filed by shareholder advocates trying to get a company to act on fossil fuels or gender pay disparities or plastic in the supply chain have been really popular resolutions at a number of companies recently. And you can go to resources like As You Sow's proxy preview guide that they put out every year. It's a free resource. You can download it. And that can give you guidance about how to vote those proxies. Green America itself also publishes a website each year where we talk to folks about how to vote their proxies and the important share owner resolutions that year. It's also gotten easier because even if you receive a paper ballot now, it comes with a little code and you can just put that into a website. It brings up your ballot electronically, you click a few buttons and you voted your proxy. So these resources can really help you. There's also now an app from a company called Iconic, where you can input all of your proxy ballots into the app that you've received electronically. And then if you use the screening from one of their partners, say As You Sow or Stand.Earth, those entities, those nonprofits will give you recommendations about how you should vote your proxies in line with climate, for example, or if you want to work on DEI issues with a company, they can tell you how to vote your proxies in line with those values, and you can accept their recommendations and quickly vote your proxies. So it's gotten a lot easier to vote your proxies, so we encourage everybody to do it. Next slide. One of the most common ways that people invest in SRI is actually through mutual funds and ETFs. And there are hundreds of those out there now. So there's a lot of options available to you as an investor. You can go to any of the platforms, say like Schwab or Fidelity. We encourage those two over Vanguard, just because Vanguard has massive fossil fuel holdings itself. But you can go to those platforms and find a wide range of socially responsible investment options, both in mutual funds and exchange traded funds. And the advantages here are when you put your money into a mutual fund, your money is pooled with other investors, and then the mutual fund purchases a wide range of stocks or bonds. So it's providing diversification and lowering your risk as an investor. It's much easier to do it that way than to invest in individual stocks. But one of the things you want to do as a social investor, as Michael said, is to make sure that the mutual funds you're selecting are in line with your values as a social investor. And there's a number of resources you can use to do that. You can go to As You Sow's website, ranks mutual funds on a number of issues, including whether they're fossil fuel free or not. They also have rankings on prison free mutual funds, tobacco free, a number of issues. and that can give you a good sense of which funds might be right for you. There's a group called Natural Investments, and they have a heart rating system. The more hearts that a mutual fund receives, the more socially responsible it is. USSIF itself has ranking lists of mutual funds and describing which screens those mutual funds or ETFs have in place. And Morningstar also has a sustainability rating that you can use. Morningstar also rates funds on their financial performance, so that can be very helpful as well. So that's a great resource to use overall. And one thing about mutual funds that you do lose is that you're not going to be able to vote your shares directly as a share owner. But as an investor in the mutual fund, you can voice your opinion with them about how they should vote your shares on your behalf. Next slide. Another way that some people have gotten involved in socially responsible investing is through retirement accounts. So there's obviously both pension plans at work, as well as 401ks and 403bs. This is a popular way for folks to invest for their retirement, obviously, with like a 401k or a 403b. There's a fairly high contribution limit each year, $23,000, and then there's a $7,500 catch-up if you're over 50 years old. The downside to 401ks and 403bs, as well as some pension funds, is obviously their employer managed investments. They decide which options you have to invest in or investing on your behalf. And in many 401k plans, ESG funds are not included. So I think approximately 5% of employers actually include socially responsible or ESG funds in their 401k plans. So there's a lot of room for growth there, and a lot of employers should be offering these but are not. And employees, actually, when you survey them, say they would like to have ESG fund options available to them. So there's a huge mismatch there. Of course, you can also invest for your retirement through an IRA, which you can do in addition to a 401k or a pension plan. Or for folks who are self-employed, this is your option for investing for your retirement. The downside of investing through an IRA is there's a lower contribution limit each year. You can put aside less money. But you can do both a traditional or a Roth, so pre-tax or post-tax contributions, depending on your income level. And you can also choose where you want to invest your money. Nobody's choosing those options for you. If you're doing an IRA through, for example, Schwab, you have hundreds, if not thousands, of options of where you can invest your funds, and you can choose those for yourself. Next slide. And as I mentioned, there aren't too many companies that actually offer 401ks that have socially responsible investment options. So Green America and a number of other organizations out there are trying to change that. And on our website, we developed a free guide with Social K, which is a platform that offers socially responsible 401k options to employers. And basically the idea is we want to encourage more people to approach their employer and explain to them why it makes sense for them to include socially responsible investments. So if you get to the next slide, we have our 10 easy steps for doing so. And in large measure, this is about educating yourself about SRI, which you're doing right now, but also finding some other employees who agree with you. And then as a group, going to your HR director and talking with them about why it makes sense for them as an employer to include SRI options in their portfolio, why this is going to be good for employee retention and recruitment, because people really would like to have those options, and how it's not going to harm them in any way or negate their fiduciary duty to their employees to offer competitive options in a 401k plan, because as we've noted, the performance of 401 of socially responsible options is equivalent to non-SRI options. Sometimes they're not terribly receptive at first, so it's good to be politely persistent and come back with some more other employees and approach them, provide them with data, provide them with other companies that are actually incorporating SRI into their 401k options. And sometimes they will start to add a few options into the plan. So it does really help to be persistent, and some folks have actually succeeded in adding SRI options into their retirement. Next slide. Another really easy way actually to be an SRI investor is to be a community investor. And one of the simplest ways to do that is to open a checking or savings account or a CD at a community development financial institution. There's banks and credit unions all over the country. Green America on its website has a resource called Get a Better Bank, where we have a bank map with hundreds of institutions and thousands of branches around the country. What we're looking at are certified community development financial institutions, credit unions and banks, as well as some banks and credit unions that belong to or are certified by organizations such as our Green Business Network. And these are all institutions that when you deposit your money with them, they're putting it into local communities. They're building affordable housing. They're helping entrepreneurs. They're really making a benefit in the world around you. And if you're currently got your money at a bank like a Citibank or a Chase or Bank of America, unfortunately, those institutions are taking your money and in large part are lending it out to things that you probably don't agree with, like the fossil fuel sector. So Chase is one of the largest funders of fossil fuels in the world, for example. So if you're banking with Chase, they're taking your money and actually creating harm with it in the world. Whereas if you move your money to a community development bank or credit union, you're actually creating a much better world and building your own community if you're banking locally. And the next step up from that would be to invest in things like loan funds and retail notes. I'll just call out a couple of them here because they have a pretty low entry point. Calvert Impact has been around for 30 years, has a fantastic track record. They pool the money of their investors and then they put it in turn into loan funds and other products that are investing directly into communities, both in the United States and around the world. And they work on things like climate change, helping entrepreneurs all over the world, social services. There's a number of things that Calvert does with your funds. And to invest in a Calvert note, you can start at $25. So it's a very low entry point. Another interesting option that Green America actually worked on is the Connecticut Green Bank. So that's a bank in Connecticut. It's a state chartered bank that invests in a way to create a green economy in Connecticut in terms of clean energy and energy efficiency. And you can either buy one of their Liberty bonds, which is $1,000, or they've recently also added $100 notes. So for just $100, you can become an investor in Connecticut's green economy. And we're hoping that model is replicated around the country. And from there, there's a bunch of other options. Some of them are listed here. These are all great institutions that are investing in their local community. Some of them have higher entry points. Sometimes they might be more like $5,000. The other thing to note about these options is they're actually not insured. So while Calvert Impact, for example, has never lost anybody's money, you just have to know that they're not insured, unlike a bank or a credit union. Next slide. So for a lot of folks, when they hear all this information, they think that's great, and I'd love to do that, but I feel a little overwhelmed, and that's perfectly fine. I personally, even though I've researched this topic and worked on it for years, when I went to invest my own money, I went to a financial planner because I wanted to map out a financial plan for my own retirement to make sure that I was investing enough money so that I could eventually retire. And also just to get advice about having a diversified portfolio. And so I think it's a great option for a lot of people. You can either hire a socially responsible financial planner on an hourly basis or a percentage of the assets under investment basis. It's up to you which way you want to do it. With an hourly basis, you work and they develop a plan with you for your retirement. They help you decide which funds to invest in, and then you go and actually put your money into those funds. If you do the percentage-based model, they actually just do all the work for you and report out on how things are doing. So it's basically your comfort. But we definitely encourage you to work with a financial planner who has a real specialization in socially responsible or ESG investing. So you can find folks on Green America's Green Business Network. Also, US SIP has a membership directory, so you can find some really good options there. And then when you do approach that financial planner, make sure you speak with them about their experience in sustainable investing, what percentage of their clientele is sustainable investors. Do they have a questionnaire where they assess your preferences around ESG, what kinds of things you want to include or exclude from your portfolio, as Michael mentioned? And do they have model portfolios that are entirely ESG? And are they part of a network of financial planners who specialize in ESG? Because those are folks where they're going to continue to receive training on ESG as well as financial planning in general. So you want to definitely work with somebody who really knows the topic well. Next slide. And I'll leave you with that, and we're happy to take any questions. Also on the slide, you see myself and my colleague, Kathy Becker, who I think is on this call as well. She's joined us this evening, so she could feel free to join in and answer any questions. And then obviously Michael from USIF, feel free to reach out to any of us if you have any questions. Also in the slideshow, a lot of the resources there are actually clickable links. So if it's possible to share out the slideshow to anyone who's taking part in this call, that would be great, because then people can just go ahead and click the links if they're interested in any of the resources that were presented tonight. And with that, I think we can turn it over to questions and answer any that were in the chat.
Yeah, thanks, Todd. Thanks, Michael. That was awesome. So I did see one question that was directly related to something you presented, Todd. So under the active investor slide, you mentioned shareholder resolutions, and Carolyn, who's in the chat here, asked, how do these come about? How, if at all, can an individual investor play a role?
Sure. Well, generally speaking, individual investors generally vote on the share owner resolutions. But if you actually own enough stock in a company for a long enough period of time, you can file a share owner resolution. The threshold, I believe, is $2,000 for 2 years. It's been a while. 3 years, sorry.
It's
3 years,
now.
yeah.
Three
Changed
years
over the
now.
years.
I'm sorry, it changed. Yeah, so there is a threshold there. And a number of smaller socially responsible investment firms actually do file these resolutions. It's not just the large share owners that file them, like a CalPERS or a New York State Retirement. So it's a fairly low threshold to file a resolution, but most people don't do that. They usually use their voice as an investor to vote their shares. Also, you can go to the share owner meeting as a share owner. So there's an annual general meeting of stockholders each year, and I've gone to them. I've either borrowed somebody's shares or used shares that Green America holds. And I've spoken out at share owner meetings to raise important issues around the environment or social justice directly to the CEO and asked them to directly answer the question in front of all their share owners. So that's another thing that you can do. Michael, other thoughts?
Yeah, I just want to say that part of the question that I saw in the box was, is there any result that comes out of it? And I'm happy to report that yes, and almost every year there are some good news that comes out of these annual meetings. So first of all, as Todd said, you could, as an individual, write a proposal if you had a business concern that directly impacted the company, and they might have to bring it up if there are no ways to oppose it along the way for or some grounds to dismissal. But just to share a couple of examples, since Todd mentioned, if you are either part of a coalition that approaches a company with a resolution that everyone supports within the coalition, and or if you own a fund company like Green Century is a company that is fossil fuel free, and they will engage corporations seeking specific outcomes. So in addition to, of course, having an investment product that has some long-term performance results, they will engage individual corporations and try to get them to address specific issues about sustainability or the environment. So I'll give you a few that just happened in the last year that I think are kind of fun stories of, you go to a shareholder meeting, you bring the proposal, and then something good comes out of it because the company says, okay, well, even though the vote was a majority of shareholders wanted to do it, it's not binding. We don't have to do it, but we do agree it's a good idea. So, for example, Kraft Heinz was approached by shareholders and has now committed to making sure that all of their supply chain considers the protection of forests and more specifically avoids deforestation for things like palm oil. And I think that's a big deal, especially for those of us that like to eat things like Nutella. And if you own an Apple product, like an Apple, like an iPhone, another proposal that we saw come through, and actually it went through Google and their Chromebooks, iPhones from Apple, and even if you, for those of us that work in ag, John Deere products, a right as a owner of the product to repair without losing the warranty. That used to be the second you cracked the screen or something, if you repaired it on your own, you lost all rights to claim that something else had gone wrong with the product from the company itself. All of those companies agreed through shareholder resolutions to engage with the owners of their products and say, actually, yeah, you aren't violating terms of service anymore. You have the right to repair your own product. And that's important, right? Because a part of it is pollution and additional waste from having to buy new things all the time. But the other part of it too is that they're recognizing that some of the things that we agree to when we click on new terms of service aren't fair. And as individual investors, sometimes large professional coalitions can get a company to rethink it. So yes, being an active investor really can make a difference.
And I would add too, so in a prior role years ago, I used to file shareholder proposals, and sometimes they end up on the company ballot, like Todd mentioned. Sometimes investors also negotiate with the company and say, hey, this is a thing that we want. And those proposals don't actually end up on the ballot to be voted on because companies will agree to implement what is being asked of them. And so change also occurs even before that, like, as part of that shareholder process. And I think it's really important to look at mutual funds and see, what are they asking? Do they have these conversations? Maybe they do file proposals, but they don't but maybe it doesn't make it to a vote because they're able to collaborate with a company and reach a resolution. And so there's all sorts of different questions that one can look at. And I think that there's a lot of successes that do come out of that process, or by way of that process, even if it doesn't necessarily go to a vote all the time.
Yeah, and I'll just add that a lot of times when shareholders are filing a resolution with the company, there are environmental or other organizations that are also campaigning against that company on a similar issue. So when companies are hearing both from environmental advocates that they need to move on something, as well as their own share owners, it really is a powerful surround sound for those companies because they're hearing from consumers who purchase their products, they're hearing from investors who actually hold their shares. And the investors are often, in that case, the more reasonable party in their mind. So they'll sit down and negotiate with the investors because the consumers are asking and the environmental advocates are asking for far more, because we're allowed to ask for far more when we do campaigns against companies than share owners are allowed to ask for. So I think it's all part of a larger movement of trying to move companies in the right direction, and shareholders play a very vital role in that.
And I guess, there's a question in the chat, which I think I'll broaden a little bit, in that, how can you find out if a pension fund or any investments that you're involved, or how can you find out if you are being offered ESG investments? I think, Todd, you mentioned that not all plans or offer that. And how do you know if they do?
Yeah, I think, well, if you have like a 401k, I think it's a good idea to talk to your human resources department at your company to find out what's in your 401k. And you can also just do some research. You can actually look at what options you have in your 401k and look online to see if those are actually socially responsible options or not. And in terms of your pension fund, you can talk to the fund manager to find out if there are any screens in place, if they're screening out fossil fuels, if there's divestment from fossil fuels. And also they usually have a statement on their website as a pension fund about what guides their investment decisions. And if they actually are divested from fossil fuels, they're going to tell you there. And if they're not, it's really key to band together with other employees and make the case to whether it's a pension manager or whether it's somebody running your 401k, why it's not going to hurt performance to take a socially responsible stand, as Michael said. And one of the key things that's really exciting now is whether it's a pension fund or a 401k, there's a growing number of entities out there that have, for example, divested from fossil fuels. And there's a track record that those entities have after they've divested from fossil fuels. So there's trillions of dollars divested from fossil fuels around the world at this point. So it's not a new thing. And those entities are seeing competitive performance and the data is out there. And so it makes it a lot easier to approach, say, a pension fund and say, you know, we should be divested. We're actually behind the times here a bit, and here's why other funds have done it, and it's worked for them. And Michael?
Yeah, I don't have much to add other than to say, you said it, a lot of times websites for your pension plans will share if they've got a particular approach or how they might work in sustainable investing or as active share owners, if they've got long-term net zero goals, what specifically they might look at when they're considering climate risk. But I think the most important thing is, as an individual, if you're in the plan, you've got resources and points of contact, right? So if it's something you want to see, I promise you the plan won't change if they don't hear from people. So even if you think they're doing it, I would put in a phone call or an email and say, hey, I'm a member, an employee of, and part of this plan, and I want to see action taken. Can you tell me what efforts you make? They might have a plan that they could share, or even share particulars of the portfolio holdings. And then, you know, the other thing that is really important for those of you that have 403B or 401k plans where you don't currently have options, and as Todd said, they may not be so receptive the first time you reach out. One thing that is for sure is that these types of retirement plans fall under the Department of Labor and the ERISA Act. And the guidance on that act is that funds that consider ESG data should and can be included in retirement plans. Todd did also tell us that very few plans currently are doing it, but they aren't prevented from doing it. And there was real intentionally murky guidance prior to the last 3 years, hoping to curb retirement plans from including them, but they absolutely can. So if you hear no, don't take that as a final answer. Keep pushing, because it is totally under the fiduciary responsibility of the plan's capabilities to consider funds that use ESG data, and you should push for it.
So I don't see any other questions in the chat right now, but I had some questions that I want to pose to you both. You know, Michael, when you were going through your presentation, you mentioned on the screen, I saw a lot of different terms, and like sustainable investing, SRI, and you mentioned that they were interchangeable. But if I was talking to a financial advisor, what do you think is the best one to use with them, given that they're all interchangeable? Which is the one that most people would know?
So I would say the most widely recognized term at this moment is sustainable investing. We just see it, first of all, I think more and more companies that were using the acronym ESG are starting to use it less because it was under political fire last year. And I'd say sustainable investing is all encompassing, right? So the way we look at it at USCIF is that includes folks that are approaching it from a socially responsible standpoint. That includes people that are engaging companies just on environmental issues or just on social issues, just on government issues, governance issues. Some of it is direct impact investing. So, you know, Todd mentioned the notes that you can buy, or banking with local development banks. Sustainable investing kind of covers all of that. So it's the terminology that we use the most, but you know, that's probably the first part of the answer to the question. I think if you've got an advisor, it's also possible that they use something else. If they've been in the industry for more than 20 years, there's a good chance they call themselves socially responsible or an impact investor, and both of those are also correct or fine, but I think it just depends on the geography and how long somebody's been doing it.
That's really helpful to know. I think another question also related to the financial advisors piece is, Todd, you had a bunch of questions on a slide, and that folks could be asking their financial advisors, like, how many clients do you have that use that are interested in sustainable investments that you work with? And, what are the right answers? What answers can they give that would help someone understand if that advisor has that knowledge or that experience?
Well, I would say the best advisors are ones who primarily work with clients who are into sustainable or socially responsible investment, because that means that that's what they're doing day in and day out. They're satisfying the needs of those clients, which means that they're constantly researching the best options of mutual funds or stock holdings or what have you that align with an ESG perspective and portfolio. They are the ones who are going to know high impact community investing options that might work really well for you as a client. They're just going to be much more attuned to all of that. They're also going to be aware of how you can use your money actively as a share owner and help you be an active share owner with your holdings. And if you work with somebody who just dabbles in SRI, they probably won't have that vast body of knowledge, and they probably won't be able to give you as good of advice. So that's why we encourage people to really seek out somebody who's, specializes in ESG or sustainable investing. Michael, you want to add to that?
Yeah, I totally agree with all of that. The one thing I will say in defense of the advisors who are maybe newer or less experienced, one really exciting development of the last 5 years in our field is that technology has offered so many more easy ways to access socially responsible investing. So you might find that whether it's because of a family member or because of maybe a particular retirement plan structure, you have to use an advisor from the plan, at least for an initial period of time. It's now possible that even if they don't have individual expertise, they may have access to a platform that can give you the kind of solutions you're looking for, and maybe some specialists who can assist them to make sure you're getting what you want.
Okay, thank you for those. I'm going to read off some of the questions in the question and answer. There are a lot of really good ones here. You've certainly covered, I think, some of them in general terms, but I'm going to shift gears and go to the very first question, which might be getting basic, but Lori's asking, how can we see how well our mutual funds or ETFs are doing? So, Lori, you might want to, it depends on your platform, of course, but that's getting back to the basics, but I think we should cover that if folks are wondering.
Yeah, absolutely. Well, for example, if you invest with Schwab, they have tools on their website that will help you see the performance of your investment, and they can actually show you the performance of your investments relative to a benchmark as well. So the benchmark would be, maybe like the Russell 2000 of companies or something like that, and it'll map it according to that to see if you're outperforming, underperforming. That'll give you a real sense there. And if you have any trouble using those tools, I know I personally have Schwab, so you can just call them on the phone, and they're super friendly. They will walk you through clicking all the buttons and how you can pull up your performance, because there's so many options on Schwab for parsing your data and looking at it in different ways. They can show you different ways of looking at that data and help you understand your performance. And if you're invested in SRI options through a 401k plan, it should be the same. They should be giving you reports out on how your investments are doing. In that case, quarterly. Schwab reports out monthly. And they should also have some charts in there showing how you're doing relative to the benchmark. So that gives you a good sense. Michael?
Yeah, I agree. In one of the slides you shared, there's a lot of tools that you can put your funds into. So if you want to see how they are doing, of course, these statements will give you absolute performance numbers, but you might also be able to figure out, if there are other similar funds, depending on what of these screening tools you might look at. and free services like Morningstar, you can put in the symbol and see how it ranks, and it'll even tell you relative to a peer group where it is, so you can find it if there are other options that you might choose.
Great. So I don't see Lori with us still, who asked that question. Does everybody here feel pretty confident that they know where to find, to get that basic performance data for any investments that they have? Because if they don't, ask now, because these folks should be able to point you in the right direction. And again, if anyone at this point, we can, we'll try to work through these questions, and then we definitely have plenty of time to raise hands and sort of be more in discussion mode, but I'm going to try to get through a few more of these questions. Bernadette asks, or says that she invested in ESG funds back in the early 90s and they didn't do well, mostly because of high fees. And so she's wondering, has that basic scenario changed? And a secondary question is speaking up to Vanguard about their fossil fuel investments as a managing company.
Yeah, well, I can speak to the 90s because that's when I started investing. And one thing I'll say is that back then, socially responsible or ESG funds were new, and they were trying to do the right thing, but they didn't always have fund managers who came from a background where they picked the best options in terms of financial performance as well as social and environmental performance. That changed dramatically by the late 90s into the early 2000s, and that's why we're seeing from the 2000s onward that the financial performance of SRI options is parallel to non-SRI options. But that professionalism happened over time. So in the early days of SRI, you actually could see some underperformance at some of the funds. So that was actually true. Sometimes SRI funds do have higher fees as well, particularly if they're actively managed, and a number of them are actively managed. So passive management would be like tracking a index, like that KLD index that Michael showed. Active management is you're actually picking the funds that are going to be in your portfolio. One of the advantages of actively managed funds, a number of them, like say a Calvert or a Parnassus or Green Century in particular, they're actually not only picking which companies to hold, they're also using those holdings to negotiate with those companies to improve their performance and are filing those share owner resolutions. So part of your fees are actually paying for the fact that your money is being very actively used to improve the performance of companies that are actually held in the portfolio. You're not just passively holding them. And on the whole, even with the fees incorporated, SRI funds still perform, even if you factor in the fees, SRI funds currently perform on par with non-SRI funds.
Yep. And just to piggyback that, I think in general, what we say in financial services is the fund industry over the past 25 years has gone under quite a bit of fee compression. So the fees themselves have all reduced to some extent. So while there still may be relatively more cost for an active manager versus an index, that cost has come down. And the other thing, just since Todd mentioned it in the 90s was also my start, those original funds that were socially responsible, that were seeking things out, most of those original ones, their only approach was to exclude industries. And I'll just pick the early 90s because I was living overseas when it happened. We had an invasion of the Middle East and a war that spiked oil prices. If you didn't own fossil fuels in the early 90s, which was the best performing sector for a few years, you underperformed a little bit. I would say if you didn't own fossil fuels from the summer of 2014 until Russia invaded Ukraine, you far outperformed because you didn't own any fossil fuels in a long window of time where they underperformed as an industry. And I'd say, timing is everything. But Bernadette, if you're open to it, I would give it a try again. There are so many more funds now. You can look at track records that in some cases go back more than 30 years, but others that so many options, as Todd mentioned, hundreds of options that have 5 and 10-year records, so you can see what you're getting into in a way that maybe you couldn't then.
And I would just add, and Leslie, if we have time later, maybe I'll go back to this, but some of the resources that Todd presented, like that As You Sow or the US like scorecard, right? When you go into it, and like I said, if we have time later, maybe I can just show it on screen. It gives you performance, fees, because fees are actually very important, especially when you're thinking about your investments and saving for retirement. And so it's something to be really cognizant of. And there are tools out there that will show you what sort of maybe fossil fuels or deforestation or whatever that particular fund is involved in. And then also give you performance figures, fees, and all sorts of other metrics that you should also use in assessing what suits you best.
Yeah, Rekha, I think now's a great time to shift that. Do you want to share your own screen? I might need to make you a host to do that.
Yeah, sure. I mean, I'll just, Todd, I kind of just pulled up some of the things that you had on there, and I figured maybe I could just show people on screen so they can get a sense of what will happen if they click on any of those links in the slides.
Yeah, are you ready to share?
Yeah.
Okay.
Okay. But yeah, Bernadette, that is also a really good question, is to make sure that, you know, you pick the right financial advisor and that they do have a fiduciary responsibility to you. And so let's see here it is. Okay. So when you look at fossil-free funds, I don't know if everyone can see my screen properly, but I hope so. But you can, you know, search for individual funds. Maybe you're already invested. I mean, I certainly am with my 403B that I had when I worked for the Illinois State Treasurer in Chicago. And so you can type in the ticker here or the manager, like a Vanguard, BlackRock, Parnassus, whoever. But if you don't, and then you can get some scores around them, or you might, and this is the fossil-free funds component of As You Sow, but you can see top-rated funds. And you can see here, you know, how they score might get an A or a B, maybe they have a few fossil fuels, maybe they have none, and what their performance is on these funds over the years, as well as the fees, which you'd see under expense ratio. That's what that means. And you can get more funds. And well, here, I guess I went into one of the funds. But when you click on one of the funds, you know, you'll see like their fossil fuel holdings, if they have any. This one got an A, so it doesn't, but others might. And then if you were to go into like the corner there, I think, Todd, you had mentioned there are other things that you could look at, like deforestation, prison, weapons, etc. And you can click into those. And this, I think, is a really great resource that could be helpful in understanding, just having a baseline understanding of what the components of those funds are. And they'll also tell you how they decide and how they score and how they make that assessment of an A or a B or a C. And you can search for it and learn what some of these terms mean. Another thing that you can do, let me try and.
This is such a great resource, Rekha. I really have enjoyed looking at this since you introduced it to me. And the scorecard in particular seemed like a one-page, everything all there in one place.
Yeah, and so hold on one second, because I wanted to share my screen, but it won't let me, like the little drop down is in front of the
No
tab.
problem.
So let me.
Yeah, and let me just let everyone know we see that there are more questions, and we will get to them. We have plenty of time. We scheduled to be here until 8 o'clock, so be patient and we will get to all your questions.
Yeah, the other piece here, and so this next one I'll go through really quick, but Todd, you mentioned the natural investments. They have their heart rating, so you know that's what that looks like. And USIF also has theirs, and so there's lots of different tools. And Todd did a great job kind of putting them out there. So I just wanted to share my screen real quick so everyone could see some of the things that are in there in the slide deck.
And as a USIF employee, I will tell you, while we do have a list on our site, I personally currently recommend both the As You Sow and natural investment sites more than ours.
Rekha, would you bring up that score? Can you quickly
Yeah.
find that scorecard page? Because I thought that was just, because this can be very complicated and there's so much information to take in and to consider. And I think some of us just want that scorecard, right? That just boom, here's the matrix here, when you're buying a product, right? You just want your matrix. And I think it wasn't this page, it had more information. Is that it? It had all the criteria in one spot.
Oh, yeah, for sure. So
Was that just a search for a scorecard or?
that is basically when you go to sustainability, which is like right here in the middle.
Okay, got it.
Next to performance, and then it actually also
Yes.
give you scores for across other areas as well. Like,
Mm-hmm.
you have a B for deforestation here, but an A for fossil fuels, but a D for gender equality. And maybe that's also really important to you. And so you can really see how they're scoring. And I think it's really important, and I don't stress, is to look at the methodology of like how they're making these scores, which they give you that information as well within the site. It's a lot to poke around through. I've definitely spent a long time going through it, but it is pretty interesting too. And so I encourage you to take a look. There's like an About Us section, which is helpful, and you can also click into some of these other values-oriented areas. But if you already are invested, maybe you can just type in the ticker and find out how the funds that you're already invested in score on these indicators. And that's a good place to start a conversation with your financial advisor.
Right. And in that vein, I'll quickly ask, what is the shield? And then, and we did, as part of the process of preparing for this event, call through lots of different, and we flyered and invited, 12 plus investment firms here locally here in Davis. And we did have one respond who said he would attend, but unfortunately I'm not seeing him here. So unfortunately we cannot send you to anybody local at the moment, but we're working on that. And then what does the shield mean?
You know what, to be honest, I'm not sure, but I feel like if you click on it, it kind of tells you the engagement grade. So this is kind of what we were mentioning earlier, is that some investors will talk to the companies and say, hey, we think that you need to set targets for how you're going to reach certain climate goals that you have, or we think that you need to provide us with more disclosure so we understand what how involved in fossil fuels your business is. And that is just engagement. And so when, I guess there is an engagement grade here as well, which I did not realize was in there, and it tells you that they engage with the companies.
Okay, great.
Yeah, and that just to expand on that. So if there's a shield on the As You Sow site, what it means is they own the company because they want to talk to it. So they might only own, as Todd mentioned, the $2,000 for 3 years, but they want to talk to them. In other cases, they own the company in a heavier weighting because they believe in the industry. Like, let's say it's food and agriculture, like a Kraft Heinz. They want to own it. It's diversified. They like the product line. But as a mutual fund company, and in this case, Green Century, they're talking to them saying like, hey, you do some things that are risks to your business and therefore your stock price long-term that we think you can improve because you have competitors who already do it a little bit better. Here are the best ways you can do it. And if you won't listen to us as a shareholder, we will write a shareholder proposal and we'll bring it to that annual meeting. But so the shield is usually a good sign on this website.
That makes sense. Thank you for sharing.
Oh, and by the way, if you can't find a local financial planner to help you who's specialized in SRI, it's perfectly fine to work with somebody outside of your locality. I mean, personally, I did. I live in Maryland, and I worked with somebody in Washington State, and through the miracle of Zoom and secure portals, it's perfectly easy to have a good relationship with a financial planner anywhere in the country. So it's more important to find somebody you like and aligns with you personally, like you get along with them and they share your values, you feel comfortable and confident in their abilities, and that's the person you want to work with.
Great. Okay, I'm going to work through just a couple more of these questions, and then I think we can start just raising hands as we wish. So Carolyn asked way back when, at least half an hour ago, and there's a couple that are related here. So you mentioned a product that I'm not aware of, loan funds and retail notes, but you covered it, but that's new to me. Can you invest in those through Schwab, or do you have to go directly to that source? And then Carolyn also asked about a threshold, and maybe Carolyn, you need to come off mute to explain what threshold you were referring to.
That might have been me. Some funds have a minimum where you have to invest $5,000. Like you can't enter into a loan fund unless you are willing to put $5,000. And there's some really specialized investment products where the threshold is $250,000 or more. So those are obviously more for accredited investors, people who have at least $1 million or more in investments under their belt. They're not for average investors. But most of the community investments are open to anyone. There's a huge range of them. And a number of the loan fund products are available on platforms. It just depends on whether they've decided to list with a platform, the platform agrees to list them, but you can find loan funds and platforms now.
Okay. Hopefully that answered your question, Carolyn. If not, feel free to raise your hand. Let's see. So there's a couple questions still about, speaking up to Vanguard about their investments. And then another one from Sunil. Is it possible to vote as a shareholder if I own an ETF MF, which has multiple companies' holdings?
I can take that latter one on voting. It's a bummer of an answer. It depends. So in some cases, as Todd said, the mutual fund company will allow shareholders to give guidance or vote on particular topics, but that's not that common. What we are seeing as technology gets better and better is even what is in the asset management space, they're called the big three. So Fidelity, State Street, and BlackRock, who have a lot of assets. Sometimes Vanguard's included in them. They are creating tools now so that even if you own funds or ETFs, that they can pass through the voting rights to you as an individual, and you get to decide based on your own values how you want to vote. And if you don't have an opinion, there's sort of an automated vote along with stewardship recommendation, but it may not be in agreement with you. So more and more it's an option, but it's not every fund company.
Absolutely. And if you do hold Vanguard, feel free to reach out to them to encourage them to divest their holdings from fossil fuels. I think about 15 years ago, I ran a campaign in conjunction with Ceres, which is an organization that works with investors and businesses to create a greener economy as well. But we pressured Vanguard, Fidelity, and American funds to actually start voting their proxies on climate change in favor of climate change resolutions. And ultimately, they all said that they would consider them. And here and there, they started voting in favor of some climate resolutions, but it took, I think it was hundreds of thousands of share owners actually joined us in putting pressure on those three funds companies to actually do that. So it takes a lot of pressure to get them to move at all. But the more they hear from investors, I think it's good that people reach out to them and ask them, why are you investing in fossil fuels? Why aren't you voting your proxies in line with share owner resolutions on climate change? I think the more people who ask them that, the better.
Just a quick logistical question. If one wanted to reach out to them, who do you reach out to? Like who do you email?
Yeah, well, at Green America, what we use is a thing called Rocket Reach when we don't know who the email of a CEO of a company or the CFO or something like that. And Rocket Reach lets you find emails of up to 5 company professionals per month for free, and they're actually pretty accurate. So we actually use that if we didn't happen to have the email we wanted. So I encourage you to try that, and then try reaching out to the CEO, the CFO, whatever you can find.
I was thinking just like, like the portfolio manager, the portfolio team or something like that, but that's even more exciting. But so for another question that we have here, do you know of institutions that have organized many people to switch to green investing as a group, a town, an employer, place of worship, a Rotary Club, etc.? Or is this pretty much an individualistic effort? And I think Green America might have some resources on how to organize people as a group.
Yeah, there definitely have been organized efforts to get like entire cities to divest from fossil fuels, for example. And so I was part of an effort in Washington, D.C. to get the city to officially divest from fossil fuels. And it was a coalition of, for example, religious groups in the city, activists, as well as folks in the financial profession, which were very valuable because they could make the fiduciary case for doing so and do it really well. And that was a multi-year effort, and DC eventually did start divesting from fossil fuels. And we see that across the country. There are groups that you can join, like Third Act, for example, is a great organization that works with folks who are 60 and above and is very active in trying to promote fossil fuel divestment around the country. And there are other organizations like that that you can join. Local 350 chapters, I think they're rebranding themselves, but that's Bill McKibben's first group that he started to encourage divestment. Those local 350 chapters, you can join those, and those have encouraged fossil fuel divestment where they're located as well, and gotten cities and towns to do so. On university campuses, student groups have organized and have been successful in getting universities to divest. So wherever you're at, you can find folks in your community who agree with you and will be willing to be active with you to encourage divestment.
Thanks. Bernadette just had a follow-up. So would avoiding, I think, Michael, you probably touched on this, where would avoiding fossil fuel holdings be the most effective method in addressing climate change with investments? And I would be curious if you guys had anything else to share on that.
Yeah, it's really complicated. I think, in a vacuum, sure, that would be perfect, because you would starve these corporations of capital. But the truth is, there's a pretty big variance across the fossil fuel companies and extraction companies in terms of their business practices. And as we know, with things like energy transitions, they take a long time. So while we set targets that are out to, 2050, and we have checkpoints along the way, sometimes the best way to make sure that we're all rowing in the same direction is that some professional investors and some organizations who maybe have like I'll say student groups, things like that, where that they might say, hey, we're going to divest because we aren't professional investors and we don't want to give any of our capital to this corporation because we know they are just net of making climate change worse. Professional investors, people that are maybe working with governmental organizations, coming up with solutions plans, things like the Inflation Reduction Act, which has a whole bunch of things that will be going into effect to fund energy transition. These types of programs, you might want a professional investor to own the shares of a company so that they're talking to them and making sure that they are taking advantage of programs, that they're being held to the highest standards of pollution and emissions in whatever places they're doing business or where their factories are, things that affect the local community in the short term. And then, I'd say it's really tough with the very, very large fossil fuel companies because they also, in their businesses, do own clean energy businesses. So we see this in Texas, which is our largest producer of solar and wind energy, in addition to, of course, being the home of most of the fossil fuel companies in the United States. They are diversifying their own businesses. If nobody owned the shares of those companies and said, hey, we like the good stuff you're doing, do more of that, do less of the bad stuff, they would probably take the path of least resistance and just keep doing what's mostly driving their business at the moment. So I don't think there's a silver bullet to it. I would argue that some people have more impact engaging them than others. So it's fair to say it's an individual choice. You can say, hey, I'm not going to own any fossil fuel companies because I just don't have the personal expertise to convince them to do better. So they're just not getting any of my money. That's my part of the solution. But there are going to be fund companies who get those shields on the As You Sow site where they're owning the fossil fuel company because they're engaging them and pushing them to improve and meet best practices and meet government regulations and achieve best possible safety structures and things like that.
Yeah, and I would agree that those approaches can work together. And also another pathway is to own companies who in turn use fossil fuels. So deliberately owning utilities, for example, most of which are majority fossil fuel run right now. You can put a lot of pressure on those utilities to do an energy transition to wind power and solar power. And because those are actually cheaper sources of energy, as investors, you could say that you're mitigating risk in the marketplace and increasing profits for me as an investor if you make that transition to wind or solar power. And it's a very effective argument that we're seeing being made with utilities. And also we pressure large corporations like Green America, who are ultimately our energy users, like the telecom industry, which uses enormous amounts of energy, about as much as New York City, to power all our little devices and keep us connected. And we've gotten them to make enormous commitments to move to clean energy quickly. So large corporations can enter into power purchasing agreements for wind and solar power, and investors have helped to drive that, as well as environmental advocates.
Thanks. So I'll actually also open it up to folks to either raise their hands and ask questions, or you can also just put questions directly in the chat if it's easier to type it. But I wanted to open up to folks to speak and ask questions. Would anybody like to do that? Feel free to raise your hand. Okay, NJ.
Yes, good evening, and I apologize, I missed the beginning of the presentation. So my question tonight isn't about green investment. It's a side note for your consideration, all of you on the panel and Cole Davis as an entity. I understand that tonight was the last segment on green finances, but I was wondering if you'll be open to sometime in the future also do an event on the impact of cryptocurrency on climate, on climate in general. So I just wanted to bring that up because I mean, it's something that is now part of, how people invest as well. And I feel like there is an opportunity to communicate with our community about that, at least either raise some flags or, share best practices or anything. You are the ones who are experts on green finances. So just wanted to bring that up as a possible topic. Thank you.
Yeah, thanks. That's definitely a really interesting topic because crypto uses enormous amounts of energy. And but thanks for the comment. That's really helpful. It's always helpful for us to know what folks are interested in hearing about. So appreciate you sharing that. Anybody else? Well, one thing that I wanted to share is we also have in one of the one of the Q&A comments. Caroline, I think you had asked about a threshold. I hope we answer your question on the shareholder resolution threshold. And oh, Francis?
Yeah, this is Nate, actually. I was curious with when trying to work with like with a mutual fund, trying to look at their like when they have a mixture of all different funds, how do you find a mutual fund that has a more green leaning than the fossil fuel?
Do you want to take that, Michael or Todd?
Sure. Yeah, so I'll say, so knowing that that's like a target, specifically a target, something like the As You Sow website that we had up earlier on the screen, that one's great because if you go in and now you can look across, I think Rekha had it up where it had all the categories. One thing is for sure, it's very difficult for a fund to do all things. So it's hard to have a fund be excellent on climate and avoiding fossil fuel exposure and be good for gender equity and be good at, let's say, avoiding weaponry. So if you know the category that is sort of your priority, I'd say if you go to the that Investor Values website, it's investyourvalues.org. If you've got your mutual fund list, whether it's in your retirement or plan, or you can plug in each symbol. It'll give you the score. It'll tell you kind of how it sits. And you can even compare then the funds within the plan. So you can say, okay, I have 10 options in my retirement plan. I put them all in, and these 3 all scored A's for climate and A's for deforestation. They maybe had lower ratings on some of the other things, but if that's your personal priority, then you might figure out, okay, I'm going to make sure my allocations at least are going to those 3. What the weighting will be will depend on risk tolerance, what the category is, but that's a great way to figure out if that's your priority, how to avoid owning the funds, if possible, that are available to you in your plan. And if you have no limitations, so if you have the scenario like Todd mentioned, where you've got an IRA, let's say with Schwab, you can put into that list, you can just choose the top scoring funds from all the families and say, okay, I'm going to choose in the broadest categories, the funds that have great scores and have, let's say, 10-year track records that look pretty good. They're averaging, I mean, they put the numbers in there, but there were some that had some pretty impressive track records. And you could say, okay, that makes me feel kind of comfortable. You still might want to talk to a financial professional, make sure that they're paying attention to whether or not there's been any changes at the fund company. Or maybe it's a new portfolio manager, things like that. But that site is really great initial guidance because you can figure out what you own. And then if you've got options that are good, and then if you don't, then you have to take next steps. Maybe talk to the HR manager who can tell you who runs the plan and go from there.
Yeah, and I think Leslie put in the link to the fossilfreefunds.org that had all of those grades and scores in the chat box. And I put in one related to deforestation free as well. And if you click on any of those funds, it gives you even more details about what they hold in their portfolio. So that can be pretty helpful to use, as well as maybe any of the other links that Todd has in his slide deck, which we'll share with everyone who's on this call. We'll email it to everyone.
Rekha?
Thank you.
Can any of you tell me why are some of the companies so afraid of letting go of fossil fuels? I mean, why are they so afraid of that? Like Stirs and Purs is the one I'm working on, but what are they thinking that it will do to their investment? Or because it's many groups have divested and it has not hurt their funds. So what is the fear?
Yeah, you're 100% right. Rekha, I don't know if you want to speak to this from a professional standpoint, but I can say we have seen plenty of white papers that have showed that full divestment has not impacted return streams very much.
Oh, and
Um,
examples we have too, places
Sure.
that have divested all across the country.
Yeah, for sure. I think the truth is most people in the financial services industry that are in portfolio management roles that have taken the CFA exam, they have all been taught to assess risk and long-term performance based on very traditional long-term indices, like the broad market indices like the S&P 500. And many of them in their jobs are judged on divergence from a benchmark. So if they are judged as a large cap equity manager on their performance plus or minus the S&P 500, if they choose to fully divest from fossil fuels, while their performance might be okay, essentially their variance or how far away they track from the benchmark might be part of their compensation. I know this is like so cynical and such a bummer, but
Oh.
some of them really are most concerned with staying close to these long-term indices, and I think to see real big change, some of the newer benchmarks. And I say newer, I'll include that KLD 400 since it's been around since 1990. That's still really new compared to some of the ones that were the basis for the education for these portfolio managers and these plan structures. So, I wish I had a better answer, but the truth is lots and lots of them in their job assessments are judged on tracking error, and by choosing to not own an entire industry, if they don't have an option in their job to track a different benchmark, that's part of the reason they might be afraid.
Also, when advocates ask a portfolio to divest from fossil fuels, so if say like a city or a state or something like that, the fossil fuel industry immediately swoops in and starts putting those fears in the portfolio manager's head that Michael just described. They come in quickly to reinforce that message and say, you don't want to do this, don't do anything hasty, not to make a mistake here, yeah, there's a lot of pressure that comes
Even
from
when
the
we have
fossil fuel
examples
sector.
all across the country of cities and states divesting from fossil fuels,
It's really helping
there's
that there's so
still
many that did.
afraid.
Yeah,
Huh.
there's still that fear.
Yeah, Lynn, the last thing I'll say on is you have in some of these municipalities that are unwilling, there are people who are paid to make sure they don't know that it works. Like it's in their job description to intentionally avoid knowing. So it's a real bummer, but some of these states, in fact, go the other way. We saw Florida kicked out some funds that were considering ESG factors. So they weren't even divesting from fossil fuels. They were just considering environmental impacts. Those funds got kicked out of retirement plans by the state attorney general, who is potentially financially illiterate, but that happened. And his campaign was funded by interests that paid him to make sure he didn't know.
Let me ask, Michael, I want to ask a follow-up question there. So aren't there sort of green indices now? Aren't there?
There are.
Okay.
Absolutely, there are. I think what is really tough is if you are a fiduciary and you, particularly for like large funds that have, some of these mutual fund companies, some of them are almost 100 years old, and they have benchmarks that go back a long time. Funds, they can change their benchmark, but it's not that often, especially if they have a long track record that they're proud of. So it's really difficult to say it's apples to apples. So yes, there are new benchmarks, there are new indices. You can invest in those indices, but not all of them have long track records, and therefore the funds haven't been around a long time. And it's it's really tough. I think there are people who mean well, but again, they look at the long-term performance history of the financial services industry, and they see funds and structures, and they've been taught, that the S&P 500 or the Russell 3000 are the big broad market indices they must adhere to because that's the pension plan's long-term target stream, let's say. So it's difficult for them to change course. It's possible, but it's very difficult.
Yeah.
Wow.
Like NJ has another question.
Yes, thank you. That'll be my last question of the evening, given the time also. I was wondering, and if you touch on that already, I apologize, but and I'm asking this question coming from an advocate, an activist standpoint. So the state of California has made this huge commitment toward, climate action and supporting all of that. And we also see that at the federal level, and the IRA is a proof of that. But I was wondering if you can give us some information regarding how that translates in, let's say, the pensions for state and government employees and so on. My point is, beside that funding, massive funding they've set aside, do you know of any other internal movement in terms of, that money for 1K plans and whatnot being actually now diverted to be invested in renewable energy or anything like that? And if your answer is nothing has been happening or you don't know yet, I'm asking because I'm wondering if that is something also that we should be asking our local government in terms of the state, to be accountable to, besides signing checks for climate action.
Yeah, I mean, I can speak to the IRA piece of it. I'll say that a lot of that money hasn't deployed yet, so it may manifest itself in great investment opportunities, and we might see people take advantage in the next, coming 5 years as a lot of it deploys. So that's exciting. And yes, absolutely, it's possible that pension plans will be able to make direct investments, impact investments into some of these things. So that's exciting. And then, to the question of regulation advancing us, I definitely think it'll help, but it's, I don't remember how you put it, Todd, but a lot of things are happening at the same time that aren't, they all have their relative impact. So for example, California just passed a law that all publicly traded companies doing business in the state of California have to disclose their scope 1, 2, and 3 emissions. That's not a federal standard, but we know that California led on car emissions, and it became a de facto standard because most of the publicly traded companies in the country do business in California. So, when that sort of data comes out, in and of itself, it's not changing anything. It's not making our efforts to combat climate change improve, but it makes everything transparent. If all these companies have to report their information, it's more easy to figure out who needs to be engaged, who the professional investors need to go to the shareholder meeting and say, hey, you're falling behind your peer group, you need to be better. So, while we do want to invest in the best types of investments for energy transition, we want to make sure that there's data transparency. So that's the best thing that we could see from the federal and state governments in terms of pressure on companies, which is make your data available to all of us as individual investors, private investors, professional investors. Because if we have the information, all else being equal, people care about this, as we've seen from every survey. And then it's a lot easier to go to those companies and say, you're not keeping up. But right now, a lot of this information isn't public. And that is half the battle, is they're getting away with it because they don't have somebody pointing out that, hey, they're a really, they're an underperformer relative to their peers or the market.
Yeah, and it's hopefully that the California example of mandatory disclosure on climate will prompt the Securities and Exchange Commission to finally come out with its long-delayed rulemaking for on the national front to require companies to disclose their scope 1 and 2 and potentially scope 3 emissions. By those we mean scope 1 is your immediate emissions, like that your company directly controls, like vehicles your company owns. Scope 2 is the energy you purchase, for example, so it's one step out, and scope 3 is your entire supply chain.
Yeah, and Todd, I'll share that we're feeling really confident in the USIF offices that by the end of March, we will see the SEC come out with the first ever climate disclosure rule on a federal level. So that could be a win.
Fingers crossed.
Yeah.
It's been very delayed.
Very.
Thank you both for the answer.
That's due to industry, by the way. Industry is not very excited about this new rule, so the delays have all been their fault,
Yes.
as you might guess. I also just wanted to quickly mention that, as Michael mentioned, there's been attacks on ESG, and we've Michael mentioned in Florida, kicking out funds that might have ESG. There's ongoing attacks against groups that actually advocate for environmental and social governance work. It's not over yet. And the US Congress, there's a committee that's actually hauling practitioners of ESG in front of it, the Judiciary Committee, and actually grilling them about their activities and trying to make it seem like they're trying to actively destroy the US economy and that they're colluding with each other illegally to bring down the US economy through promoting companies actually divesting from climate emissions and things like that. So I did want to leave everybody with an action you can all take that I'll put into the chat, calling on the Judiciary Committee to stop their witch hunt against 13 organizations who are all very actively trying to move corporations forward on climate change. And so instead of honoring those activists for the great work that they're doing, they're being persecuted for the work that they're doing. And it's really detracting from the kind of great work that they do. And one of them is As You Sow. So all those resources we shared tonight from As You Sow, they're so helpful to investors who care about climate change and deforestation and so forth. That's one of the groups that's actively being pursued by this committee. And so please take the action if you can. There's already 17,000 signatures and growing. So
Great. Thank you, Todd, Michael, and Rekha so much for a lot of guidance and information. I'm seeing one more question by Bernadette, and thank you from Emily Marie. We're at 1 minute to go. Let's see. Should we try to get Bernadette's question answered in the chat? What about contacting media companies to report an ESG benchmark when they mention the S&P and Dow Jones?
I love that idea, and I would go with the KLD Social 400 because it's the longest track record, since that goes back to 1990 and holds up really well against both of those indices, the S&P and the Dow. It would be amazing if that was part of the daily business report when they talk about what the market did. But please keep me posted. If that actually happens in Northern California, I'd be so proud of you.
All right. Again, thank you to our speakers, our moderator, our tech support, we have a fellow and an intern on the line here, Brittany and Wendy. Thank you both for being here and for all your great questions. This at the moment wraps up. We don't have plans to address cryptocurrency, but it is definitely a need. We will be signing you up for our newsletter as part of signing up for this activity. We hope you stick with us, but it's easy to unsubscribe at the bottom if you wish. Thank you so much for your donations for this event. Really makes such a huge difference to allow us to continue our work. This video will go up on our YouTube channel within a few days, hopefully. The current one that featured Kathy Becker from Green America is currently up on our YouTube channel. We will be doing a follow-up, sending you the slide deck and a link to both of those videos. If you have any other questions, go ahead and send us a link. And that is at the very bottom, that fossilfreefunds.org. Boy, do I love that. Thank you, Michael, for being honest that it's better than US SIP's scoreboard. And the other one was this one's from As You Sow, and the other one was Natural Investments.
Yep.
Yeah. So those are two. If this feels like a lot and overwhelming, it sounds like we have some pretty knowledgeable folks. But if you just need something simple, those two sources are really just narrow it down. So thank you so much for everybody being here, and have a great evening.